All right, this is second and final review video for Unit 9. Let's jump in. So we're looking at the foreign exchange market specifically here. Now remember, the foreign exchange market is a foreign exchange of currency. So we're looking specifically at currency. But when is currency exchanged? Currency is exchanged when we have an exchange of goods, buying and selling of goods, an exchange of financial assets, the buying and selling of financial assets, or just the changing out of currencies when we travel abroad or something like that, right? So foreign exchange does have determinants that are connected to any transaction that happens internationally, because every dollar has to be transferred into the domestic currency of the good or service or asset that you're purchasing. Okay, so that's a general overview of what the Forex is. Remember that the demand for goods or financial assets has a direct relationship with the demand for that currency. For example, if another nation demands more American cheese, because we use that example in class, they demand more American cheese, then in order to get that cheese, they're going to have to demand more American dollars, right? They have to exchange, they have to provide their currency and get American dollar currency so they can buy the American product. Even though that transaction doesn't happen tangibly every time, it does happen, right? If I buy American cheese in Italy, right, that money, which why would you ever do that? But that money uh, that goes back to that American corporation is going to be converted from that Italian euro into an American dollar. So that exchange is still going to happen there, right? So, and any demand for a foreign asset is going to correspond with the demand, an increase in the demand for that foreign currency, right? So, if that's the case, if we demand more of their good or we demand more of their asset, means we demand more of their currency. It also means that the demand for that currency has a direct relationship with the value of the money. Just like when I demand more of, like pen, for example, right? We demand more of this pen, the price of the pen is going to rise. In the same way, if I demand more of the American dollar, the price of the American dollar or the value of the American dollar is going to rise. We call the increased price of the dollar or any currency appreciation. And of course, it's vice versa as well. If there's a decrease in the demand for a product or a decrease in the demand for an asset or a decrease in the demand for anything being exchanged, then we're going to demand less of that currency. When we demand less of that currency, just like when I demand less of sticky notes, right? When I demand less of them, the price falls. When I demand less of the currency, because I demanded less of the asset or the good, then the price of that currency is going to fall, just like the price of the sticky notes is going to fall, right? And the currency, we call that decrease in the price of the currency depreciation. It is depreciated in value, and that has consequences in international exchange, which we'll talk about. Now, also keep in mind it's all relative, right? All of this is relative. So we're looking at one currency to another. So if the American dollar appreciates relative to the euro, then the euro necessarily must have depreciated relative to the American dollar. But that doesn't mean, if those two currencies are related that way, that doesn't mean anything about the yen, for example, the Japanese yen. So the American dollar can depreciate to the euro, but appreciate to the yen, right? In other words, there's a market with every single currency, right? So the United States dollar can appreciate and depreciate to 100 different currencies in the same day. So it gets really, really complex. But keep that in mind, because it's really important to notice or note that, if there's an impact on one good or one currency, there's necessarily an impact on the other currency. It is incomplete to say simply the American dollar appreciated. You would have to say the American dollar appreciated relative to the Canadian dollar. Okay, hopefully that makes a little bit of sense. As kind of a general overview, you keep in mind those relationships from this first bullet point here, then you should be in pretty good shape, even if you know nothing else about foreign exchange. It's kind of a key. Right? I know that these things are related in this way, so I can pretty much puzzle out what's going to happen to the currency. All right, let's keep going. So the actual market is going to be between two nations, right? Or specifically two currencies, because the European Union has this huge conglomerate of nations that use one currency. So, and that's a lot of fingers. All right, anyways, so we're always going to have two nations or two currencies involved. And if nation A demands more of another currency, and must supply more of its own currency, right? So when the United States wants more American or European euros, when the United States demands more euros, we have to supply more American dollars, right? It's an exchange. I can't just get euros for nothing. I get euros, I give dollars. There's an exchange. So every single time there's a change in demand for one currency, there's a change in supply for the other currency. In other words, if the United States demands more euros, demand is going to shift in the euro market, but the supply is going to shift right. We're going to supply more in the American dollar market every single time. And I'll show you an example of that in a little bit. Keep that in mind, always simultaneous shifts. Most of the time you'll only see one graph, but every once in a while they'll show you both. But keep in mind that there are two markets being impacted at the same time every single time. Okay, whenever you're labeling your y-axis, remember the Fordham University, right? Foreign currency over the domestic currency. That shows me the change in price, right? So here it's euro over dollar. But when it goes from E to E1, I know it's going to take more euros to buy one American dollar, right? Euro per dollar. So if this was E was €1 per dollar, then E1 might be €2 per dollar, which means that the dollar is appreciated in value because it takes more euros to buy one American dollar. Okay, so remember, if the price of the exchange goes up because of demand or a decrease in supply, if the price of the exchange went up, then that means the currency has appreciated in value. And that means there's more buying power for that currency in that international market. Vice versa. If the exchange rate goes down, then of course the currency is depreciated and the buying power has gone down as well. Okay, so right here we can see that very clearly. We have the demand shifting right for the American dollar. And there are a lot of things that could cause that. We'll look at shifters here in a second. But if demand shifts right, that means that my exchange rate went up. In other words, it takes more euros to buy one American dollar. The American dollar has appreciated in value to the euro. And that has all kinds of consequences, right? In the United States, European imports look relatively less expensive. And in Europe, American assets or American goods look relatively more expensive because it takes more euros to get one American dollar. So it impacts exchange whenever we have changes in the value of a currency. All right, let's keep going. What are the shifters in these markets? Got a little preview of it in the last section, but the first one is a change in taste. If I want more of another nation's goods, then I'm going to demand more of their goods, which means I'm going to demand more of their currency, which means that their currency is going to appreciate. If their currency is appreciating, then our currency is depreciating, okay? Or in other words, there's a direct relationship between the change in taste and the value of that currency. So if another nation wants more American-made cars, then we know they want more, which means that they're going to demand more cars, which means that they're going to demand more American dollars, which means that the demand is going to shift right, pushing up the price of American dollars, which means that the American dollar will appreciate in value. And vice versa. If people want less of an American good, then they're going to demand less, which means the demand for the currency is going to fall, which means the currency will depreciate. Okay, relative income change has an inverse relationship with domestic currency, right? So if the United States income rises at a greater rate than the foreign income, right? Our income is much higher. It means that we are going to buy more imports. We're going to buy more of our domestic made goods, but we're going to buy more import. Because they're poorer, they're going to buy fewer American exports, right? In other words, our balance of trade is going to fall. Our net exports is going to fall, meaning we have fewer demands for our American dollars because they're buying fewer American exports. Yikes, right? Demand is going to fall for the American dollar, which means that the dollar is going to depreciate in value. In other words, when our income rises, our currency, relative to another nation, I should say, our currency is going to depreciate, all other things constant. Okay, keep that in mind. And whenever you're thinking about this, just think of how it impacts exports and imports, right? Because if they demand more of our goods, then the demand is going to go up for our currency. If they demand fewer of our goods, then demand is going to go down for our currency, and that kind of gives you that key we talked about at the very beginning of this video. All right, what about inflation? Well, the relative inflation change also has an inverse relationship with the value of the domestic currency, right? So if our inflation rate goes up at a greater rate than another nation, that means in those foreign nations, our American products look relatively more expensive. The price rose. That's what inflation is rising prices. Even though in America, our wages might have went up at the same rate, in those foreign nations, it hasn't. So as a result, our exports look much more expensive. So they buy fewer American exports. In other words, they demand fewer American goods. They demand fewer American goods, then the demand for American goods is going to fall. When the demand for the American good falls, then the price of that the American currency falls. The price of that currency falls, which means that the currency has depreciated in value. In other words, inflation goes up. They want fewer of our goods. They want less of our currency, so our currency depreciates in value. Okay, relative interest rates. There's a direct relationship here because high interest rates are very attractive. So when the United States interest rates rise, going up, then our currency is going to appreciate. Sorry, so used to the inverse related. Going to appreciate in value. Here's why. When interest rates go up in the United States relative to another nation, our assets are going to look a lot more attractive to foreign nations. Going to say, hey, I could invest in American bonds and get a whole lot more income as a result of that, right? So they're going to demand more of our assets. When they demand more American bonds because of that high interest rate, then they are going to demand more of American currency. When they demand more of our currency, then our currency is going to appreciate in value. The price is going to rise. In other words, when interest rates rise, our currency appreciates because people want more of our high interest assets because they'll pay them back more in the future. Okay. Now keep in mind, I'm mostly talking about demand because it's easier to conceptualize, but whenever we demand more or they demand more, there's a corresponding shift in supply. If I demand more of their good, I have to supply more of our good or our currency, sorry. If they demand less American dollars, then they're going to supply fewer euros, for example. Now, how do you show this on the graph? Let me pull up my handy dandy writer here. Let's say that here we're looking at euro price of dollar. This is a market for the US dollar. We got our foreign over domestic, right? We have our initial exchange rate and our quantity here, right? When there's an increase in demand for our currency, people want more of our currency because they want more of our goods, or because their income has gone up at a greater rate than our income, or because their inflation has gone up at a greater rate than our inflation, or because our interest rates have gone up faster than theirs. All the different things that can cause a rise in the demand for our currency. Demand will shift to the right. When demand shifts to the right, just like you would always do, you dash over our exchange rate has gone up. In other words, the currency has appreciated in value, and now there are more American dollars in circulation with our Q2 there. Okay? All right, let's keep going. All right. So what impact does appreciation, depreciation actually have on the currencies involved? Well, first, the impact of the appreciation and depreciation is directly impacting our net exports, right? So what's it look like? Well, when our currency appreciates, it is actually going to be offset by a corresponding secondary depreciation. And this is what keeps our exchange rates relatively stable unless we have some dramatic shock, right? So when the currency appreciates, it means that our dollar now has greater buying power. But it also means that our exports look relatively more expensive. So as a result, we're going to buy more imports. They look relatively cheaper. They're going to buy more American exports. When they buy more exports, it means they demand, they're going to buy fewer of our exports. When they buy fewer of our exports, it means they demand less of our American dollars. When that happens, the currency itself depreciates in value. So currency appreciates, our goods and services look more expensive abroad. They buy fewer of our exports, they demand less of our currency. Net exports falls, currency depreciates as a result, shifting the demand of our domestic currency to the left. Vice versa. When currency depreciates, it is going to necessarily have a secondary impact, not initial, but secondary impact of appreciating. When our currency depreciates, It means that our goods and services look more attractive abroad because the dollar is less valuable. Their currency is relatively more valuable, so they can buy more American goods for a lower price. So our exports are more attractive. Our net exports rise, all other things constant. When our net exports rises, our currency appreciates in value, stabilizing that currency and shifting the demand of our domestic currency to the right. Okay, here's a little chart for you. If you're having a hard time figuring that out, you can pause the video and look over that as well. But that's a secondary shift. Just keep in mind, whenever we have appreciation, we're going to have a secondary shift of depreciation because of the impact that this has on net exports. All right, let's keep going. Now, our final thing that we need to know is the exchange rate systems. For the most part, we've been talking about floating exchange rates, where you just kind of let things go. It's willy-nilly, completely free market. The currencies can fluctuate as much as they want without any attention paid to it. Now, in our modern world, that is just super rare because nations don't want to experience huge recessions because of not paying attention to these exchange rates. So what are the downfalls of this? If I don't pay attention to exchange rates, there's uncertainty in trade, right? I can be negotiating a contract and then all of a sudden something is twice as expensive, or all of a sudden something is, they're getting half the amount of money as a result, and that can break down those negotiations. Businesses don't like uncertainty, so why not just participate domestically or go to another nation where there's not that volatile exchange rate. Uncertainty in investment. If I'm investing in something expecting a certain return, the exchange rate can impact my return. I could be expecting $100 million, but because of an appreciation or depreciation of that currency, all of a sudden I'm looking at a whole lot less income than I was expecting. Again, why would I invest if I'm not guaranteed to actually get what I'm expecting to get? And so that falls apart. And then, of course, it can cause a recession. If our currency appreciates out of control, nobody's going to want to buy our exports. When nobody buys our exports, our trade deficit rises, which means net exports falls, which means that our GDP falls as aggregate demand shifts to the left, causing a recession. Now, for the most part, we don't like that. And so nations get a little more involved. The extreme side of that is called a fixed exchange rate or a pegged exchange rate. And this is where the nation determines this is my ideal exchange rate right here. And we're going to do everything in our power to maintain the same exchange rate. Now, they can't just pass a law like a price ceiling and say, this is law. If you don't do this, it's illegal, because one nation can't pass a law for another nation. Instead, all you can do is manipulate the exchange to keep your preferred exchange rate. So here are some ways to do it. First, you can take action. You can manipulate trade, subsidies and tariffs, right? If I want to make sure that the demand for my good goes up, right? I want to shift the demand to the right to maintain that. Then I can provide a subsidy on my good, make sure it's cheaper, which means that people will demand more of that good, which means that they'll demand more of my currency, which will shift demand of my currency right, get me back to that fixed rate, right? I could, the same thing with tariffs. I could use tariffs to make goods more expensive and have that same effect. I could manipulate interest rates. I could change the supply of money, because we know how that works, to increase or decrease interest rates. Right? If right here I have the supplies or my exchange rate's too high, my fixed rate's down here, I want to shift supply to the right. How do I do that? Well, let's say I lower my interest rates. If I lower my interest rates, then foreign interests might be more attractive for our investors. And so investors, instead of buying American bonds, they'll buy those foreign bonds. And so they'll demand more of that foreign currency. Remember, if I demand more of a foreign currency, I have to supply more of my currency. So by pushing interest rates low, I demand more of their currency, which means I supply more of mine, shifting supply to the right, pushing my exchange rate back down to my fixed rate. And then finally, and most popularly, I can buy and sell my currency. If I buy foreign currency, it's going to depreciate. Buying depreciates my currency. Here's why. If I buy their currency, it means I'm supplying my currency. Supply, right here, supply shifting to the right because I'm buying more of their foreign currency. I can just exchange it out, basically. But vice versa. If I sell my foreign currency, if I sell it all, right? We have this whole pile of money. We sell that foreign currency. It means that we demand less of their currency. If we demand less of their currency, then we are supplying less of our currency. If we demand less of theirs, we supply less of ours. There's less of an exchange, and it will push the price up and appreciate our currency, right? So that's pegged. What you really need to know is when the exchange rate goes out of that pegged range, what would nations most likely do to get back to that fixed exchange rate? You know these three things. Okay, final slide. This is most popular is a managed float. And the managed float is basically instead of pegging your economy, which could cause a recession and is just counterintuitive and very difficult to do. Instead, we do a managed float. We say, you know what? This is the lowest our exchange rate can be without it being catastrophic. This is the highest our exchange rate can be without it being catastrophic. As long as it's within this range, we're just going to let it float around. You know, it can go up, it can go down, that's fine. But whenever it starts to creep outside of these parameters, then we're going to get involved. And what we've done over the years is instead of just having one nation get involved in this, because that can cause trade wars, instead, we do it with a bunch of other economies, right? We say these are the exchange rates that we want to have. And collectively, we're going to buy and sell currencies when it falls outside of these parameters, right? So what happens when we buy a currency? Well, we buy currencies if we want to depreciate our own currency. If I buy more of their currency, it's going to appreciate their currency. It's going to depreciate my currency, right? But when we're looking at the G8, which we'll talk about in class, when we look at the G8, which is a bunch of major economies, they'll just focus on one. And they'll say, okay, the European or Greek, for example, Greece, their currency appreciated beyond control, right? The euro, because of what they were doing. It appreciated. Yikes, right? We don't want that to happen. So instead, what they would do is they would sell all of their euros. When they sold their euros, they would supply more euros into the market, which would shift supply to the right, as we see here, supply going to the right and depreciating the currency, getting it back within the range, right? So I'll show you that with the marker here. So they sold euros. When they sold euros, there are more of them in the market, and it pushed the exchange rate from up here outside of the parameters to down here, point C, within the parameters. So if they want to appreciate a currency, let's say it goes below value, like point B down here, what do? Well, all these nations instead say, hey, it's falling outside these parameters, it's catastrophic, let's get involved. And they all agree, all the nations collectively at the same time, buy more of that currency. When they buy more of that currency, the demand shifts to the right. When the demand shifts further right, it goes from B back to C within the parameters, right? That's how it works. Buying and selling of currency. If all of these outside nations buy more of your currency, you're going to appreciate your currency. They sell more of your currency, it's going to depreciate your currency. Flip that perspective. If I'm back here, go back to that last slide. If I'm back here and I'm pegging, that means I'm doing it alone. I'm not with all these other nations. If I'm pegging and I want to appreciate my currency, then I need to sell that foreign currency, right? When I sell the foreign currency, it is going to decrease the supply of my currency in that market, appreciating the value. And if I want to depreciate my currency, then I need to buy more of that foreign currency. When I buy more of their currency, my supply is going to shift to right, depreciating my currency. All right, that's it. That's everything you need to know for the exam. Make sure that you're able to draw a foreign exchange market and show shifts with those determinants. That's going to be your FRQ. All right, have a great one. See you tomorrow.